I think it's like going to the dentist, going to the doctor. You're going to an expert, hopefully, to work
Mm.
with someone who knows the financial markets, who knows where things are going, has some outlook for the future, and wants to know what your goals are, what your aspirations are, what your risks are, and can deliver to you financial results over the long term. We don't judge anyone. Everyone is different. Everyone is unique. Everyone has different needs. Everyone has different spending habits. Everyone has different risk tolerances. It's all about knowing your customer. And I believe that's true of every financial advisor. That's that's part of what we need to do when we say we know your customer. The thing that most of my clients look at is we produce a quarterly performance report that says this is the amount you started with, this is what you've added and taken out, this is what the gains have been or the losses, but usually gains, and this is the ending value. You know, you have a TV set. I have a TV set. I don't know how it works. I have a remote control that turns it on and off and changes the channels. I don't need to be a TV expert to operate my TV. You don't need to be financially literate to manage a financial plan. For some people that want to do it themselves, that's probably true. Studies show that financial advisors actually add to the long-term performance. And in our case, we have a passion for creating wealth. Our comparison to most financial advisors is significantly higher return than the average financial advisor. We won't get somebody 25% over the long term.
Yeah.
Uh, and if somebody can do 15% on their own, they should do it on their own. So we compiled a composite of our clients that are invested in the stock market. And that's a composite of everyone who was with us before Adam's Financial Concepts and everyone that has at least 1/4 of performance. And that average performance over the last 20 plus years has been 14%, over 14%. So an 8% is considerably below where we perform. And if you look at that over 20 years, the nest egg invested with us is almost 3 times what it was for somebody with 8%. We're fiduciaries, which means we have to make every decision in the best interest of the client. That's a standard for every registered investment advisor, every advisor representative. It's not necessarily true for the big brokerage houses advisor. They're considered registered reps. We are fiduciaries, and every single decision we make is in the best interest of our clients. I've never had a client come and ask a question about that. We're straight up. People can look at their account 24 hours, 7 days a week. It's completely transparent what we do and how we do it. So we've not had problems with fraud or defrauding clients. It's all there for them to see. For people that really want to handle their own finances, they should do that. If they're looking for returns, if they're looking to grow their accounts and grow them at a significant above average rate, that's what we do. And we're very good at it. If you look at all the studies that have been done, there's somewhere between 1% and 3% of professional money managers that do as well as we do. I don't know of any financial advisor that does as well as we do. No, I don't know of any clients that do that well either. It does take a lot of time, and yet there are people that really enjoy doing that and feel that that's a good use of their time, or at least it's something that keeps them active and going. We have a number of people that I've talked to who like to trade a portion of their account and leave the remainder of their account with a financial advisor. They get to be involved, they get an excitement for their own side. And even if they don't make very much money, they just enjoy the fact that they can buy and sell
Mm-hmm.
on a short-term basis. And they leave the real heavy lifting to us. So there is a conflict of interest because we don't get paid if we don't work with somebody. In our case, we charge a fee. And in our case, we're one of the most expensive, if not the most expensive financial advisor anyone's going to work with. And we believe that you get what you pay for. But there are advisors that will try to sell. It's maybe less true today than it was when I began 40 years ago. Back then, there was a time of you got a commission every time you did a trade. And so there were people that wanted to do a lot of trades and churned accounts. Less so with fee-based accounts because a fee is charged no matter how many trades are done, whether there's 0 or 90, it's the same price. Less so today than there was 40 years ago. Financial advisors get paid in a number of different ways. They get paid hourly, they get paid on commissions for certain things that they do. For Adams Financial Concepts, we strictly get paid a fee. Get paid 2% for the first 2 million and 1.75% for everything over 2 million. That's a fee. And we only make more money when the account does better. If the account doesn't do as well, we get paid less. So there's an incentive for us to do better for our clients. It depends upon the client and what the client would like. For some clients, they don't need any real connection with us. I had one client that she became a client in 1986. She continued to be a client until her death last year. In that whole period of time, we talked on the phone maybe once a year. I never met her. She brought a couple $100,000 into her account, and it was worth almost $3 million when she did pass away. She looked at her account every quarter to see what she put in, what she took out, and what the gains were, and what the ending value was. That was enough for her to just monitor that amount, and we didn't have any contact. There are other people that are friends that I see it, at least one friend I was seeing almost weekly. We talked about his business, we talked about this business, we talked about his account and the stocks in the account. Those were the two extremes. Some people want to meet once in a while. For me, I like to keep clients involved in what's going on. And so I do a newsletter that comes out like 40 times a year. That's a lot. I do workshops so that they can see what happens in the workshop. Prior to the workshops, I was doing a radio program every week. So I try to keep clients informed and informed not just on what has happened in the past, but what I think is happening or will be happening and what that impact will be with their accounts. It's as little or as much as a client wants to be involved. We're not the kind of firm that wants to have a meeting every quarter to explain what things are going on. Most of our clients understand the market is up and the market is down. We're going to see highs, we're going to see lows. We are invested 100% of the time, although that could change in the next couple of years. We have been invested the full amount of time. Studies have shown that being invested 100% of the time creates the most wealth. Trying to pick out trading days has been a reduction. If you miss just the 10 best trading days, you cut your returns in half. That may be changing coming up in the next decade, but we'll see what happens. We don't offer a financial plan.
Mm-hmm.
We believe that financial plans are deceptive, they're misleading, and they're based on wrong statistical assumptions. We believe Monte Carlo simulation is based on the normal curve, or the bell-shaped curve. That doesn't hold true in the market. We believe that the data depends upon when you begin to collect it as to what the returns are going to be. We believe that asset allocation is a reduction in returns. And not only do we believe that, we see the average financial advisor producing between 5 and 6% a year. We're producing 14% a year. And of course, past performance is no guarantee of future results, but that's a 20-year track record. That's not a short period of time. We are required by law, as is every other financial advisor, to know your client, to know the goals, to know the risk tolerances of the client. That's a requirement. That's not an option. We see advertisements for most financial advisors that we listen to you, we implement your goals and your risk tolerances. That's a requirement by law. If we don't do that, we're in violation of the regulations and rules. Every single account that we have is custom built to the client's goals and risk tolerances. Every single account. I don't think there's any two accounts here that are exactly the same. We do. One of the things that's typical of our client portfolios is they do not have a large position. They're concentrated portfolios. They're based on focus stocks. Studies have shown that's a better return for clients. That's where we are, so that our focus is on understanding the investments. We understand it in detail. If you look at our strategy, I look at 30 to 40 stocks a month. I look at the finances on 8 or 9 of those a month. I drill down and read the 10Ks and the 10Qs and all the information I can find on those on 1 or 2 a month. And then we only do 1 or 2 trades a year. So we're really focused on what we do. And there's a limited number of stocks in client portfolios, so that it's fairly simple to follow what's going on for every single client account. We're not spread all over the map. We have a due diligence program, which is thorough and complete. And that works for every client. Mm-hmm. I think most people understand there's ups and downs in the stock market. And if you don't want the ups and downs and can't live with the ups and downs, then the best thing to do is bank CDs. Ups and downs go with the market. I'm always reminded of what Will Rogers said when he was running for president. They said, "What stocks would you buy?" He said, "I only buy stocks that go up. What if they go down? I don't buy those." I wish it was that simple. Stocks do go up and down, and there's no one that says they only do better. Maybe except for Madoff. He claimed that. Never a down quarter. If somebody tells you that, you know that they belong in the Madoff camp or prison. We all have a conflict of interest. Every single person has a conflict of interest, because when we charge a fee, we have an incentive for the accounts to generate greater fees. And you do that if you're a only fee-based advisor, you only get more fees if the accounts go up or if you bring in more accounts. And there's a big push to bring in more accounts. We get most of our growth through client returns going up. But that's a conflict of interest that exists with everyone. In addition, there may be other conflicts of interest. All those need to be disclosed, and they're disclosed in a document called the ADV, and that's public information. It discloses, or should disclose, in our case, it does disclose every conflict of interest. I believe that there's a lot of undisclosed fees. We disclose all of our fees. Everything is transparent and above board. But in mutual funds, you have up to 17 different hidden fees. You have, I use the example. If you set aside $10,000 and you're 22 years old and you want to take the returns out at age 67, if you invest that in the Standard & Poor's, you would have over $480,000. But if you invest that in mutual funds, you don't have 480,000, you have 280,000. 220,000 went to the hidden fees and to the advisor fees for what? And for Wall Street, they get to take all that. Wall Street makes a lot of money from their clients. We try to have every single fee visible and completely transparent. That's not true of mutual funds, ETFs, annuities, all alternative investments. All of those carry significant hidden fees. And that's why the results are what they are. The average financial advisor, 5%. We're at 14. We have. And we respect that, and we will do that. We've also got clients who want to have some things in their accounts, which we don't recommend. So we will do that. But we don't include those accounts in our composite because they're not managed accounts by us. They're partially managed by us. One of the strange stories is when I first got into the business in 1986, one of my clients that I talked to was a woman who was, I think, 45 years older than I was. And when the market crashed in 1987, I had been talking to her just about municipal bonds. When the market crashed in 87, she said, "Shouldn't we be buying stocks?" She had a very high risk tolerance. She had made a lot of money in her lifetime because she was willing to take the risk. And even at the age of mid 80s and 90s, she was a risk taker. On the other hand, I have had young people who are in their 20s who are pretty conservative and don't want to take much risk. It depends upon the individual, not on the age. Some people in their early years are conservative and don't want to take the risk. Some people that are older have a high risk tolerance. And even having a lot of money, still want to take high risk. Depends upon the client. We build everything to the client's need. One of the conflicts of interest that I have was I had a company that was involved in converting a former Soviet military plant to commercial aviation. So I got very involved in talking to people in the country of Georgia and in Russia and the Ukraine. I lived a year and a half in France when I was younger. I find that the people are graced with where they might be born. I was graced by being born in the United States. Some people are born in different countries, do not have the advantages I have. But essentially, we're all human beings. There's a brotherhood of man. There's a brotherhood of man, and that's who we are. The clients I love are the people where the financial situation they're in is very meaningful. If you talk to a Bill Gates, if he lost 90% of his wealth, it wouldn't affect his lifestyle at all. If he lost 90% of 90%, it wouldn't affect his lifestyle. I have clients that if they lost 10 or 15% of their wealth, it would change their quality of life. You know, I like and have stories of clients who came to me with a limited amount and have seen their wealth grow, and it's made a difference and maintained a quality of life, or giving them a quality of life which they didn't even expect. Those are the great stories. I don't think you have to understand the industry. You just have to understand your situation, what you start with, what you add, what you take out, what the gains are, and what the ending result is. It's as simple as can be. I think one of the great examples is Warren Buffett. Started in the 1960s, was a Graham and Dodd type investor. In 1972, realized that that strategy no longer worked, sent money back to his clients, went to Columbia, got his MBA, and then came back out and started up again with a different strategy that he's continued to work with for a number of years before making another shift in his later days, because he had so much money under management. The old way didn't work. So there are times in which a change is necessary. It's realizing when a change should happen. It comes from experience. It's something that you live with and you understand, and you understand when things are not working and why they're not working. There are going to be downtimes when the strategy still is valid. It's recognizing what the difference is between a normal downtime and when a strategy is not working.